Hi everyone, a very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. This is your daily dose of personal finance news, views and opinions. Let's get you a gist of what we have lined up for you today. Well, now that the festive season of Diwali is behind us, I'm sure many of you, whether to the occasion of Bhai Dooj or otherwise, have received gifts, perhaps even money from your relatives, your friends, your neighbors, family members, even your employer. However, did you know that the taxman actually has an eye on those gifts as well? There are certain categories of the gifts that are taxable as income from other sources. What exactly are these gifts? When should you report them in your income tax return? That's what we'll be discussing, and of course we'll be answering your questions and queries as well. So if you have any questions you'd like to ask us on taxation, you can write into us on The Money Show at etnow.tv. Later on the show, we'll be bringing on board the fund manager of the Tata Equity PE Fund, Sonam Udasi. So if you've got that fund on your radar or in your portfolio, stay tuned for that. And finally, we also will be in our Spend with TMS segment talking about what exactly are the new curfews and limitations that have been imposed by the government. So let's first talk about the taxation bit, the news that has come in over there, and bring on board Karan Batra. Karan, hi, good evening. Thank you so much for joining in. To start with, let's put forward a very simple question. Are these Diwali gifts that we receive really taxable?
Hi, Mubina. Good evening. Well, the answer to your question is yes and no. So, what the law says is that if a person receives gifts which are up to 50,000 rupees, then these gifts are exempt. However, gifts received in excess of 50,000 rupees, these are taxable. Now, it is important to note that this 50,000 limit is per annum. So, we'll aggregate all the gifts received during the year, and this is per annum from all sources, from all people, and we'll sum it up. It is also important to note here that if somebody receives a gift of, say, 60,000 rupees, then the entire 60,000 will be taxable and not the differential of 10,000 rupees. So yes, up to 50,000 rupees, these gifts are exempt. If these are in excess of 50,000, then the entire amount gets taxable as income from other sources.
But sometimes it's. I mean, how do you give a monetary value to these gifts, because they are not necessary in the form of cash? They come in kind as well. So do you sort of attribute a monetary value to these gifts as you receive them?
Yes, gifts received either in cash or kind, both are taxable. So say, for example, you receive a gift. So say, for example, you receive an iPhone of 1 lakh rupees. Then we'll have to ascertain the value of that. And on this 1 lakh rupees, we'll have to pay tax. So yes, even non-monetary gifts, gifts in kind, we ascertain the value and pay tax.
All right, even non-monetary gifts, just because you haven't received something in outright cash, but instead it's been given to you as a gift. It could be perhaps a snazzy new television set, for all you know, from a very generous donor. That as well could be taxable, and it's important to understand that. Now let's understand the source of this gift. Karan, we get gifts from our neighbors, family members, sometimes employers as well. Is it taxable even if, let's say, my father gives me a gift, Karan?
See, gifts received from relatives, they don't fall under this 50,000 rupees clause. So gifts received from relatives, they are tax-free. There's no tax to be paid, irrespective of the amount. So even if your father gifts you, say, 10 lakh rupees, that is not taxable. So gifts received from relatives, these are not taxed. Now the point comes, who are the relatives? Is your cousin your relative? No, your cousin is not your relative. So in the definition of relative, what they say is that your spouse is a relative, your brother or sister is a relative, your brother and sister, the spouse of the individual is a relative, brother or sister of the parents of the individual are relatives, and any linear ascendants or descendants, these are relatives, and lineal ascendant or descendant of the spouse of the relatives are also relatives, and of the above mentioned people, the spouse, these are also relative. So gifts received from any of these categories, these are tax exempt. It is also important to note that gifts received from these people is exempt, not gifts made to these people. So say, for example, I received a gift from my uncle who is falling in the definition of relative, then that is tax exempt. But if I make a gift to my uncle, then in the hands of the uncle, it will be taxable.
Okay. All right. Understood. So, and I'm assuming obviously you can't even claim it as an expense, right? Because just to get that out of the way, Karan, that if I want to make a gift to my offspring, or like you mentioned, my niece or nephew, I cannot claim it as an expense either, right?
So for you, these are postal expenses. So you cannot claim these as an expense. But if a business owner is making a gift to his client, he can say that this is my business expense. So the business owner can claim this expense if it is incurred for the purpose of business. But for you or me, for where it is a personal case, then it cannot be claimed.
Okay, all right. So, giving a gift is a personal expense. If individuals like me or Karan essentially give a gift to anybody, it could be a friend, family, relative, don't think that you can claim it as an expense really, and perhaps reduce your tax liability. That's out of the question. Of course, if we have a company and we sort of give gifts to our clients, our suppliers, to maintain those business relationships, then it's a different matter altogether. And for those individuals who receive gifts in Diwali, monetary wise, of course, it's important, but also who are you getting the gift from? This is well important. So from your immediate family member, your father, your mother, from your child, it's fine. But then there will be a limit of 50,000 rupees that will kick in. And also, let's say if you get a gift of 70,000 rupees, it's not that balance 20,000 rupees that's taxable. The entire amount will be taxable, which, by the way, brings me to my next question, Karan. Let's say if I have got several gifts during the year, how do we sort of accumulate all of them and then look at the value, or is this sort of 50,000 rupee limit applicable for each individual gift?
So it is the aggregate value of all the gifts received from all the people. So in this case, what we'll do is we'll add up all of these, and if it is more than 50,000, then it gets taxable. So it is not per gift or per person, but aggregate limit.
All right. So aggregate should not, exceed, that 50,000 rupee. And like I mentioned, you can't think of it as if you have, you just have the differential amount or anything like that. The entire amount is essentially going to be, subject to tax. By the way, Karan, under what category of income does this fall into? What would be the, and how do you sort of tax it? Is it simply added up to your, the other income that you have, which may be from your salary or from your business income?
Yes, so this tax has income from other sources and would be taxable as per the slab rates. It is also important to note that this 50,000 limit is not per family, but per individual. So I can receive gifts of 50,000 rupees and my spouse can receive gifts of 50,000 rupees. So it is per individual.
Karan, it's also, of course, we're talking about gifts received during Diwali. However, there are other events as well when you do receive gifts, and it may not be taxable. Since you're talking about the topic of gifts, and of course, we have an upcoming marriage season as well, so it'll be interesting to get in your take on that. We get gifts on several occasions: birthdays, marriages, when your baby is born, so on and so forth. So how essentially and most of the times, especially during marriage or the birth of a baby, the gifts tend to be a little more high value in nature because that's a one-time event, unlike a Diwali. So what's the tax treatment for these gifts?
So all these gifts, they are included in the limit of 50,000 rupees, except gift received on the occasion of marriage. Gifts received on the occasion of marriage would not be in this 50,000 limit, and any gift received on the occasion of marriage is tax exempt, and there is no maximum limit for this. So gifts received on marriage, they are completely tax exempt.
And this obviously regardless of whoever you get the gifts from, it could be a colleague, a friend, or whatever, Karan?
Yes, gift received from anyone.
All right. Okay. Great. All right. You know what? I just had one more question with respect to the newly introduced tax stops on house property, but I'll take a very short break before we do that, ladies and gentlemen. We'll be taking on board your questions and queries as well. So if you have any questions on taxation, you can write into us on the Money Show at etnow.tv. We'll take a very short break. Back, you're watching the Money Show on ET Now. Let's, before I just take on board the questions and queries that we've received from our viewers, I just want to talk about one more topic, and that's with respect to the recently announced tax stops by the finance minister. Karan, it had to do with comparing the rate at which an individual buys a home, that too, mind you, under 2 crore rupees, versus the circle rate. So what was it earlier and what's the tax stop now? Does it sort of encourage home buyers also to go ahead and buy a home?
Yes, Navina. So sometimes what happens is that there is an anomaly that the circle rate is higher than the market rate. In some areas, circle rate is also called the guidance value or the ready reckoner rate. So earlier the law was that if a person purchases a property which is less than the circle rate, then the differential would get taxed. So earlier there was a exception that if it is up to the differential is up to 10%, then it would not be taxed. If it is more than 10%, it would be taxed. Now it has been changed, and it says that if the differential is up to 20%, it would not be taxed. And if it is more than 20%, then it would be required to be taxed. I'll just explain this with the help of an example. Say, for example, a person purchases a property whose circle rate is 1 crore rupees, but he purchases it for 85 lakh rupees. So he has purchased it at less than the circle rate. So earlier, because the difference is more than 10%, it was taxed and tax was required to be paid on this 15 lakh rupees. But now, because it is within the limit of 20%, so tax would not be applicable. So yes, this is good for the home buyers. However, it is important to note here that it is only for primary sale of residences. So when a person is purchasing from a developer, it is only applicable then. If this is a resale property, then this clause is not applicable.
Okay, very important here. It was first the difference between, what you actually buy the property for versus what the circle rate is, or ready reckoner rate or reference rate. If it exceeds 10%, then, you used to be taxed. But, now they've increased that to 20%. So there is some room as well. It's good for developers, it's good for buyers as well, because developers are ready to be a bit more flexible on pricing, given the fact that it's clearly a buyer's market at this juncture. And, they need really buyers to come out there. But of course, it very important clause over there, which Karan mentioned, you need to be buying the property, a brand new property from the developer. So that's important to understand. You can't be buying, a property that already has been purchased by somebody else in an existing building. Okay, well, let's take on board some questions and queries we've received from our viewers. The first question is from K.R. Ravi. He says, which are the most tax efficient investments for retirees? Karan, what would you recommend? Unfortunately, I can understand that tax efficient, yes, but maybe the returns will not be that great because, the government has had to cut interest rates on quite a few instruments. But yeah, what's your view on these tax efficient investment instruments?
For senior citizens who are retirees, the best tax efficient sources are PPF and tax-free bonds. So one, these earn interest, which are safe investments. Moreover, the income from these is also not taxed. This is completely tax exempt. So PPF and tax-saving bond is, tax-free bond is something that they can look at.
Okay. So that's the view coming in, Mr. Ravi, on essentially some options available for you. Let's take on board another query. PK Kanan writes in saying that I am aware that advance tax need not be paid by senior citizens. Is it applicable at the present situation of the extended income tax return date? Because I would like to avoid paying interest on advance tax if needed to be paid. Okay, in fact, we will be having another due date for the advance tax coming up on the 13th or the 15th of December. Karan, what's your understanding of this? Because now the income tax return has to be filed only prior to 31st December.
Yes, this year is an exceptional year where we've seen such high extensions for so much time. So for this year, even for senior citizens, what government says is that if the self-assessment tax to be paid is less than 1 lakh rupees, then interest would not be applicable. However, if this is more than 1 lakh rupees, so it would be applicable. So even for senior citizens whose tax liability is, self-assessment tax payable is more than 1 lakh rupees, interest would be applicable.
All right. Okay, so that's how essentially this should be treated, and yeah, it's, I guess, changed a lot of things because now we have this extended income tax return date. Okay, one more query. Srinivas MG says, should I pay any tax for short-term capital gains on a debt fund that I have enjoyed if my income is zero in that financial year? So what is the tax implication on STCG on debt funds, Karan, and what happens to individuals like Srinivas?
So STCG on debt funds is added to your total income and is then taxed as per the slab rates. So if the person does not have any other income and his income from this is also less than 2.5 lakh rupees, then there is no need to pay tax because as per the slab rates, it would not be applicable.
So very obvious, STCG is added to on debt funds, of course, is added to your income. If your income is zero, then, of course, the STCG as well should not be exceeding the limit of 2,50,000 because then you'll have to pay tax on it. But yeah, if it's under 2,50,000 and you have no other income, then there's no need to pay tax as well. Okay, Manish Keswani says, if I have a joint property with father and son, can the son claim HRA benefit if he pays rent to his father due to financial requirements of his father? But it's a joint ownership, so that could be a little tricky. Karan, what do you think? Do you think, the son can claim HRA?
Yes, rent can be paid to the father. Even for joint property, it can be paid to the father for his share, and the son can claim an HRA. It is important to note here that if you're making the rent payment to your father, then you can claim the HRA. But if you're making the rent payment, sometimes people pay it to the wife. That is not allowed because husband and wife are treated as one family. So you can pay the rent to your father for his share of property, and then you can claim the HRA. It is also important to note here that the payment should be made via bank transfer, and you should have proper rent receipts, and you should have a proper agreement. So if any of these is missing, then the exemption would not be allowed. So ensure that the money is transferred via bank accounts, you have the rent receipts, and there's a rent agreement, and your father discloses it in his income tax return.
Okay. All right. So husband and wife, this kind of an arrangement would not be okay because you're obviously considered as one family unit, but between father and son, it's fine. Karan, as always, a pleasure having you with us on The Money Show. Thank you so much for joining in and helping our viewers out with their questions and queries. Folks, we are always here every day at 5 p.m. So if you have any question or query with respect to your mutual fund portfolio, with respect to investments, taxation, insurance, write into us on The Money Show at etnow.tv and we'll let you know when we will be taking on board your query. Time for a very short break. Don't go anywhere. We'll be bringing on board your Meet Your Fund Manager segment when we return.